President and CEO of the World Economic Forum. Jared, I'm going to start with you. So just give us a quick lay of the land. What do you mean by instrumental capital, and how does it tie up sovereign wealth funds, state capital, state champions, and why is that so important today?
Thank you, Ravi, and thank you for publishing the essay as well. It's great to be here with dear friends. I think we have an annual tradition of speaking on a panel together for the last several years. Let me set the context a little bit, which is, as everybody in this room knows, the idea of lots of wealth in the Middle East is not new. The idea of wealthy sovereign wealth funds in the Middle East is not new. Kuwait was the first to create one in 1953. So the question is, why are we talking about a new wealth of nations now? Why do we feel we need a new term like instrumental capital to talk about how these countries are deploying resources? The reason is you have $14 trillion of sovereign capital spread across 170 different sovereign wealth funds in the world, and 5.6 trillion of that is concentrated in 4 countries, Qatar, Saudi Arabia, UAE, and Kuwait. In 2015, it was only 2.2 trillion, and by 2030, it's expected that $8.8 trillion of capital are going to be sprinkled throughout 4 countries, right? That's unprecedented in history. Now, what's interesting is even though the idea of sovereign wealth funds goes back to 1953, until the mid-2010s, it was kind of a relatively uninteresting story of passive investment. But when new leadership came to power in the 2010s in Qatar and Saudi Arabia, and to some extent the United Arab Emirates, these leaders brought with them a new set of ambitions to diversify economies, lead in science and technology, and deploy capital abroad in ways that aligned with geopolitical interests. The problem was the geopolitics were driving the economic interests of these countries, not the other way around, and the Middle East continued to be stuck in this war on terror international relations framework, and for lack of a better way of putting it, it was still a geopolitical jungle. Fast forward to COVID, and the geopolitical center of gravity shifts from the Middle East to Washington and Beijing, and all of a sudden that geopolitical brush is cleared. And that ushered in this new era that we describe as the era of instrumental capital. And what we mean by that is during the time from when these leaders came to power up until the present, the capabilities and the infrastructure for investing reached entirely new heights. And now what we see with the deployment of resources from each of these countries is, yes, there's an expectation of outsized economic returns, but when we talk about instrumental capital, we're talking about state-led funds that are being deployed with a dual mandate, to generate those outsized economic returns, but also to project state power in a way that's accretive to the domestic goals and the international goals of the leadership that runs the country. And this capital is long-term, it's patient, and is meant to be highly strategic for what these countries are trying to do.
That's a great overview. Borge, I'm going to ask you to pick up. Now, obviously, your hat is the World Economic Forum hat, but you were previously Norway's foreign minister, which has a very substantial sovereign wealth fund. Just in the spirit of trying to discern what is new here, can you give us a sense of how Norway's sovereign wealth fund is different from what we're seeing now with what Jared was describing in the Gulf countries and their wealth funds?
No, thank you. I'm very happy to do so. You know, the Norwegian sovereign wealth fund is only $2 trillion US. So but it's not insignificant. It's not insignificant. But let me first put it a little bit into context. What makes these sovereign wealth funds very interesting is that these countries have a lot of saved resources. While most of the countries now globally is more indebted than at any other time since 1945. So many countries now have as their biggest expenditure on the state budget is interest on their loans, including the US, that is the largest economy in the world, 27% of the global GDP, 5% of the global population, but still uses most money on its state budget on interest rates. So these countries that have the sovereign wealth funds, they have decided with extraordinary revenues, many of them from oil and gas, have then decided to put it aside, invest, and then use the real interest in investing in their people or pensions for the future. The Norwegian sovereign wealth fund, as I said, around $2 trillion US dollars, is really started to save money back only in 2000. Only in 2000. When I was trade and industry minister back then, every year we put all the revenues from the oil and gas sector into the sovereign wealth fund. Big pressure among voters saying, oh, we should use this money now, we should invest in our people. But then there was consensus in Norway. Let's put it aside. And today, the largest revenue in the Norwegian state budget is the real interest of the sovereign wealth fund. At the beginning, we were able to take out 4% of the real interest, but then it became too much money because we can't put that much money into the state budget too. So now we have capped it at 3% or 2.75. So what I would say for nations with extraordinary revenues, for example, from natural resources, it's a good thing to put it in the sovereign wealth fund and then rather use the real interest. But the real interest then needs to be invested in future competitiveness. That is what is important in research and development, in infrastructure, things that then creates also future values in your country. So that's where the Norwegian story comes from.
That's great. Deemah, this is a great time to bring you in. You have worked in the public sector and private sector in Saudi Arabia. You're a woman. Give us your sense of the importance of what sovereign wealth funds can do. And again, riffing off of what Jared said, this idea that it's patient, stable, long-term, but it's also projecting state power and building out capacities.
Oh, definitely. Thank you for bringing that up. You know, we see that especially now in the digital era that we are living in, it is transforming in a very exponential rate. Technology is not as available as it was before. The advancement of the technology is very fast, and therefore, for countries to diversify their economies and bet on digital economy, they need to transform as countries. But this is where the infrastructure comes in. Can the private sector take on such kind of building that infrastructure, either from submarine cables to cloud computing and the whole stack of that infrastructure? And this is where governments come to a point where, yes, we have to create stimulus business environments to support the private sector, but also governments need to invest in that infrastructure. And this is where sovereign funds come in, and investing in areas where private sector institutions lack that investment. I'll give you an example. We represent 16 member states. We did a study around these 16 member states, and we saw that around the 60 member states, we have 160 subcables. Amazing. You know, you would look at, wow, they're rich when it comes to connectivity. Actually, no. 15% of that number is reliable. The other is unreliable, either old technologies, which is submarine cables from copper, not fiber optics, or other that is not fit for the future of AI and quantum. So this is vulnerability that these countries will be facing. So from that, with that 16 countries, imagine that there is only one company within the 16 nations that does submarine cable maintenance. Now, who can create such kind of companies? Sovereign funds. And this is where we've been working with actually the sovereign funds of our member states, is how to invest in such kind of infrastructure to make sure the digital resilience and reliableness of the sustainability of the growth of their digital economies.
Jared, if we zoom out a bit from here, can you situate us a bit? So you've got the sovereign wealth funds, you've got, especially in the Gulf, the rise of all of this catalytic money, instrumental capital, as you put it. But at sort of a higher level, you've got this big competition between the United States and China, and the world is organizing itself around that. Talk a little bit about their models and how they're either taking advantage of this new money or that money itself is playing the two sides against each other?
Yeah, so when you talk about US and China in the context of sovereign wealth, it gets quite interesting. There's a historic piece of context here, which is so far we've been talking about sovereign wealth funds that have been funded based on revenues from commodities. But one of the things that's interesting about the sovereign wealth funds in China and in Singapore is those funds ended up being funded by virtue of trade surpluses and non-commodity revenues. And so that was kind of this interregnum area, but it was those sovereign wealth funds, again in Singapore and China, that were kind of early pioneers for strategically deploying their capital in ways that aligned with their geopolitical interests. And we're familiar with the Belt and Road Initiative with China and so forth, but we're also familiar with the enormous amount of state capital that they're deploying domestically. So I say that as just historic context. There's two features of US and China that I would mention. There's a lot of talk right now about the US sovereign wealth fund and so forth, and who knows where that will end up going. But the reason countries have sovereign wealth funds is because there's an absence of deep capital markets, right? So the US, having kind of the deepest capital markets in the entire world, hasn't really had a need for a sovereign wealth fund, whereas countries that lack the capital markets, like in China, but have 1.4 billion people, it served a very important function. Same in countries in the Middle East that have kind of more nascent capital markets and smaller economies and smaller populations. The sovereign wealth fund has allowed them to play at a really robust level, which we can come back to before. But the third dimension of this gets to not just we've talked about the concentration of wealth in 4 countries, but what we haven't talked about is why that wealth has been allowed to be so strategic and so up-leveled and so essential to everything that's playing out in the world, right? Like as I mentioned before, wealth in this region is not new. The way in which that wealth is empowering the countries is, and it is a function of the fact that for the first time in history, America's 3rd largest trading partner is also its most formidable adversary. And that causes people to look at US and China as if this is a second Cold War. This is not a second Cold War. It resembles none of the attributes of the Cold War, except for the fact that you're talking about 2 large countries with 2 large militaries. The Soviet Union and the US were never economically intertwined in the way that the US and China are. What that means is whether you call it a strategic competition or a competitive coexistence, neither the US nor China can gain the upper hand without relying on other countries. And what this has done is it's allowed a group of countries, like the 4 that I mentioned earlier, Saudi Arabia, Qatar, UAE, and Kuwait, to emerge as a sea of geopolitical swing states who have a differentiated amount of capital that they can deploy wherever they want without having to worry about the political or geopolitical backlash. They have a differentiated part of the supply chain. They're attractive for nearshoring, offshoring, and friendshoring, and each of them is led by an individual that has a global agenda independent of Washington and Beijing. So that geopolitical context, which has been fueled by sustained tension between the US and China, coupled with just the accumulation of wealth, plus the fact that since the advent of these sovereign wealth funds, the capabilities and the capacities and the investment know-how has really germinated, is part of why we're in a situation now where, just to give you a concrete number, to give you a sense of the scope and the scale, in the first 8 months of 2025, $56.3 billion of global deal flow was accounted for by sovereign wealth in these 4 countries. That's 40% of the global deal flow in just the first 8 months of 2025, which is extraordinary.
Wow. Borge, I wonder if, as we talk about the growing salience of sovereign wealth funds, whether it's worth thinking a little bit about what that does to global order and equality within that order. So how concerned are you that we could be creating a winner-takes-all world, or at least a world in which the countries that cannot afford to be a part of that change are not geopolitical swing states, but are a layer or 2 below that? What happens there?
No, that's a really good question. I think we already saw with the platform economy that the big preferred platforms also became very strong companies. So it was already a little bit the winner takes it all. Then you can say today, though, with the new technologies, artificial intelligence being one, quantum, also a lot of the other ones, autonomous vehicles, all that, it could lead to a winner-take-it-all situation. Let me come back to that. The other thing that could come to a winner-takes-it-all is that if you accumulate a lot of capital, as some countries do, they will have huge influence through that capital, because there are other countries that are incredibly indebted. As I said, some countries are more indebted than at any other time since the Napoleonic Wars. We have to go that far back. So if you look at future potential bubbles and black swan or black swans, I would say probably the most challenging bubble that we would potentially face if we see low growth in the years to come would be the situation related to debt. There's of course a lot of talk about potential bubbles on AI, potential bubbles on crypto. You cannot exclude that, but I think that would be more adjustments. And we have had bubbles before that have burst, but you know, .com too, but we saw a lot of strong companies coming out of that, and in the market economy, it does happen once in a while that you have those bubbles, but I would be very worried about a debt bubble. So we have the AI and the huge investments there. Can that create only a winner takes it all? And with the capital, those that have capital compared to those that don't have capital, that can also lead to a winner takes it all. So what is my perspective? What do I think there? I do think the jury is still out on the new technologies, on AI. I think we know in the hardware phase where you see trillions of US dollars invested in the new language models and all that. But there can be a moment later on where you go more into the software phase, where you also will have incredible smart people coming up with things that also does not necessarily need to come from the big companies. You know, who knew about ChatGPT 5 years ago? Today they're a very big company. If you look at the 10 largest companies in the world today, when it comes to market cap, many of them did not exist 25 years ago. So it's not like a priori given that the winner is necessarily the one that is big today. But of course they do have an amazing capital flow that they know can invest in AI instead of necessarily borrowing all the money to invest. They can use their running flow. So that makes it different. But of course, the countries with the large sovereign wealth funds are in a privileged position, but they also have chosen not to use the money but save it. And that is also to avoid the Dutch sickness. And then and my last point is, you have different categories of sovereign wealth fund. My country, Norway, has decided to invest the money instead of using it in a sovereign wealth fund and then use the real interest. But we have also decided that it's not a tool to promote Norwegian interest per se. So we are totally transparent about the investments. We own on average 1.75% of all globally listed companies, or Norway does. Then they are also saying, the Norwegian Sovereign Wealth Fund, that they only take 5%, up to 5% in these companies, to avoid a situation where it is seen as a political tool. That's a national decision, and we're very transparent. Go on the website, and you can see all the investments. So that has been Norway's kind of policy related to that.
Deemah, of course, not every sovereign wealth fund is as transparent as that. And I'm curious about your perspective in the region, and maybe specifically with Saudi Arabia. If you look at some of the big projects, Diriyah, Neom, there are concerns that they've spent a lot of money and they're having to scale back a little bit. What kinds of checks and balances within sovereign wealth funds do you see that inherently exist? and what are the corrections they need to be thinking about in the future?
Well, definitely, as Borge mentioned, in every sovereign fund has its own strategies, either to invest outwards, inwards, where to use that interest as well. I do see, although I'm not an expert in that domain, but I know that PIF, which is the Public Investment Fund of Saudi, is working actually now on their strategy, and it's the time for the refresh. And I think that since Vision 2030 launched, the strategy of PIF was to invest nationally and internationally. Nationally being that vehicle that will create new economies that are linked to Vision 2030, like tourism, technology, sports, education, and of that sort, and also investing in projects that are infrastructure related, that will enable other private sectors and ventures to build on top of it. And I think the projects that you have mentioned were building blocks for such kind of projects. Definitely throughout the years, we've seen the fruits of such kind of investment, either Giddiya, now it's open. This month, we have seen the Red Sea also is open, and it delivered on its promise. A lot of other projects as well delivered their promise, and projects that have delivered their promise now is being analyzed to either accelerate or either to reduce or decrease the investment in. And I think that's something that every sovereign fund should go through, which is assessing their investments and seeing how to take that direction forward. But I do encourage now, looking at where we are as the Digital Cooperation Organization, collecting the intelligence and the data of what is the must-have for every country to be digitally economy sustainable, especially with the era of AI, and that increase in the divide, which we will see. $300 billion investment in AI last year. A handful of countries were able to be part of producing this technology, which means that more than half of the globe was not able to be a producer, but a consumer. And this is where the sovereign funds should be looking into areas where how can you capitalize on each other as countries and not work in silos. With this advancement of new technologies, when it comes to infrastructure, cooperation is essential. A competitive advantage in a country could be a solution for a challenge in another country. And this is where, let's highlight, like the Gulf, for instance, their competitive advantage, strategic location, capital, energy, cheapness of energy, and that could be capitalized on in countries that have the computing power and also that have the brain power. And this is where they can complement each other. I do expect to see in the future more collaboration within sovereign funds. We are working in the DCO on new agreements on how to create collective investments within the region together, especially in cloud computing and in infrastructure like submarine cables. So a new model, I think, of cooperation between sovereign funds have to be put in place for the sustainability of growth of these countries.
Jared, I'm wondering if you have a take on how to do that, but also as you think about that, I'm curious if we can overlay demographics on this whole issue, because you know, there was a time where demographics was destiny, and here you have the countries that are able to deploy large amounts of capital. Obviously, they have much smaller populations, and so this deployment of capital is able to diversify their sources of revenue, but then eventually maybe even attract new demographics.
So I think the demographics point is incredibly important and essential for understanding that the Middle East is not some monolithic blob that bleeds together as one kind of geopolitical sea of wealth. I think part of the thing that I find fascinating is everybody, so many people in the business community today have woken up and realized the Middle East is important. People have been coming here since the advent of sovereign wealth funds for allocation into their funds, and that era of passive capital where you can come and just by showing up you differentiate and come away with money, that era has been over, not just for a short period of time, but really for quite some period of time. Part of what it means to have that era over is the Middle East. It's interesting. You look at you look at the region of the Middle East, and each of these countries is operating more as an independent country, punching way above its weight on the global stage, and certainly way above its population size. So when you try to understand what is the difference between what Saudi Arabia is trying to do with its wealth, what Qatar, Kuwait, and UAE are trying to do with their wealth, I think it's useful to view it through the lens of people. So if you view Saudi Arabia as a starting point, Saudi Arabia is unique in that it has more than 35 million people. And so differently than the other countries, it's absolutely essential that the deployment of that sovereign wealth leads to not just employment opportunities for the population, but really up-levels the human capital. As Deemah will attest, historically Saudi Arabia has had a tradition of merchant families, and it's moving towards up-leveling a younger population into an era of entrepreneurship and thought leadership. And so many of the investments that are focused abroad now require bringing a knowledge economy into the country. So that's kind of what's unique about Saudi Arabia. Here in Qatar, you have some of the best infrastructure built in the entire world. It was built in the lead up to the World Cup. I like to say that the World Cup was the IPO for the modern country of Qatar. And now Qatar, as it sort of looks beyond the World Cup, is focused on how do you attract another 2.5 million people who are permanent residents who come with their families and live in Qatar from around the world. And if you look at what Qatar is doing, they can't do what Saudi Arabia is doing because there's not 35 million people, so you can't just rely on the population you have. And they don't want to copy what they're seeing nearby in UAE. Some of the most recognizable brands in the world for Qatar are its national champions. Qatar Airways, Qatar National Bank, Al Jazeera, Ooredoo, et cetera. If you're a brilliant person and you want to work for an airline, if you're given a job at Qatar Airways, you'll move your family to Doha to take that job at Qatar Airways. And if you look at some of the best human capital from outside of Qatar that's living and working here with their families, they're working for national champions. The challenge that Qatar has that they're trying to address is they don't have enough national champions to fill that out. And I think it's a very exciting opportunity for the country because you have ready-made infrastructure to be able to do that. It's a totally unique situation where the infrastructure is built in anticipation of germinating a whole ecosystem of national champions that can connect Qatar to the rest of the world. In the case of the UAE, they have such a first-mover advantage. They're unique demographically in the sense that it's less about attracting foreigners to live in the country and more about not losing that first mover advantage of being the place where companies want to have their headquarters and where people want to live. And if you look at what they're doing, they're leaning into that first mover advantage to really aggressively try to pursue through a whole ecosystem of sovereign wealth funds, not just a single one, emerging as one of the world's, or if not the world's greatest sovereign investor. And then Kuwait is an interesting story because they were the first to have a sovereign wealth fund, as I mentioned before, but they stayed in the passive investment paradigm for quite some period of time. And it's only in the last couple of years that you've had a paradigmatic shift in Kuwait, where you have new leadership at the KIA, new leadership sitting on top of a lot of the different big allocators. But what's fascinating about Kuwait demographically is they're emphasizing building it all with Kuwaiti nationals. And you see that through a variety of policies now.
Borge, you have such a great vantage point in your role at WEF. I'm curious how, when you hear all of this, how do you think the rise of sovereign wealth funds, and I guess with it, the rise of the Gulf states, how is that changing geopolitics? I mean, we were talking the other day about how the lens through which many of us are seeing the world now is realism rather than privileging values or anything else. There's been a shift. And I'm curious how you tie that together with the changes we see here, and whether that's a good thing, or how you sort of characterize what it does to global order.
So I choose to have a real political approach to that. The world is moving in a more multipolarish direction. We're not there yet, but that's a reality. And I think what economy has shown, and globally, is that we've been much more resilient than we thought maybe even a year ago. So we're much more optimistic now on the global economy than we were just 1 or 2 years ago, where we had a real concern that we could go into a period with all the geopolitical turmoil, all the tariffs, into a low growth decade. You know, in the 1970s, we had almost zero growth, and then it was also a lot of economic challenges. But we're seeing now is 3.2% economic growth this year. It's a little bit lower than the trend growth that was close to 4% for decades, but it's not too bad, and especially with the most complex geopolitical backdrop in decades, we're still trading, we're still seeing growth. That's good, and we do think that the paradigm shift that the new technologies do represent is maybe the new engine of growth. Like trade was the engine of growth for decades. Trade grew twice as much as the global growth and pulled global growth. I think we will see now the same with the new technologies. A year ago in Doha, we discussed, was there going to be a hard landing, a soft landing in the US economy, and there's no landing. And why is that? $500 billion invested in AI this year. This is amount of money that is staggering, but I think we already see some productivity gains in the economy. So I'm more optimistic moving forward, provided that there are no major wars, there are no major bubbles related to sovereign debt. And of course, we have to avoid any kind of pandemic, so we have to, of course, collaborate to be better.
I mean, we already have wars, and there's an open debate about whether we're in a bubble.
That we cannot afford. I would say on the sovereign wealth funds, though, coming back to that, we have to also remember what the history is. The history was that one wanted to avoid the Dutch disease. So the Netherlands used so much of the gas money in the 70s that the inflation became higher, and they didn't really get that much out of the extraordinary gas revenues. Now they're doing well, and this is also my point. There are countries doing extremely well in the world without sovereign wealth funds too, but those that have extraordinary revenues have learned from the Netherlands and the Dutch disease in the 70s. They rather save the money and use the real interest. And over time, it has shown that equities is a good way of saving money. But we should not forget that every country has a responsibility to look after its own competitiveness. Look at Argentina. Maybe the richest country in the world in 1945. That took the Peronistas 10 years, and it was a lower middle income country. Look at South Korea, zero natural resources, at least close to zero natural resources, was on par GDP with Kenya in 1960. Today, the GDP per capita in Kenya is in Korea is 32 times the one in Kenya. So I'm still, with all this talk about winner takes it all the talk about sovereign wealth funds, we will see nations that prosper also moving forward because of hard work, investments in education, investments in R&D, excellent courts, not corrupt politicians, great governance, hard work, and willingness to really address the very fundamental issues.
That's a really great point. Deemah, just to pick up from there, your last point about, how it's important to invest in a way where you're cooperating and not just competing, but also in a way that keeps in mind inequality within countries. And, you know, for example, one of the members of DCO is Pakistan. And I'm curious how, on the ground, you're able to see policy-making shift outcomes when it comes to inequality, or if there are any cooperative mechanisms you're seeing that are working.
Well, I do see it. I'll go back to and build on what Borge mentioned, which is the intention. The intention of these countries and that positive attitude to prosperity that we see now in a lot of our member states. And that intention is opening the opportunity for them to change and to change that mindset of when we, for instance, when you mentioned Pakistan, we're running an initiative with WEF actually in Pakistan, which is driving digital FDI. And the essence of that is what are the reforms that they have to take in place as government for them to attract the right investments, and also what are the packages and incentives. And here is where the openness for such kind of an activity and also working on the reforms in just 18 months, that gives indication that the willingness to change and the willingness to bet on diversifying economies. 2 months ago, we celebrated in Islamabad actually attracting $700 million of investments in digital assets within Pakistan. Why? Is because we identified where the opportunity is and we connected to the right of the supply with the demand, and here's where we accelerated that aspiration. We're doing the same thing in Cyprus, Rwanda as well, and now in Oman. And we see in each country, it's a different landscape, a different competitive advantage, where if we double down on that, we bring it to the surface for the investors, then this is where we can bridge that communication gap between the private sector and the investors. We are working with development funds as well, because we noticed that with sovereign funds as well as with development funds, they are willing to invest in infrastructure if they know where the opportunity is and is it based on certain statistics and measurements. And this is where we came up with the Digital Economy Navigator that identifies the gaps. We provide that data for the sovereign funds and also for the development funds, and we have seen a 10% shift in the mindset of the way that the sovereign funds and development funds are working with governments to deploy development projects in digital infrastructure.
Jared, I'd be remiss if I didn't put to you that sometimes big bets can go dramatically wrong. What if we're in an AI bubble? What will that do to all of these different sovereign wealth funds that are at this point quite heavily invested in the AI ecosystem, and that will create winners and losers within this general group and class of winners? How do you see that playing out?
So look, we're in a really interesting situation right now that I would say is kind of off script from history, just because if you look at the AI ecosystem, it's unprecedented amounts of money that are being spent in all aspects of the value chain before we know what the use cases are that will justify the spend. I don't actually think if there's a bubble, it's going to be because people decide generative AI isn't important. I think if there's a bubble, it's going to be because we can't get to the use cases fast enough to keep up with the investment thesis, right? So that's where I see you have kind of a timeline problem. I think what's interesting is if you look at the 4 big sovereigns, I increasingly, when it comes to AI, I refer to them as the sovereign hyperscalers. And I do that because if you look at Silicon Valley, right, the big companies in Silicon Valley, the hyperscalers, they compete with each other, they partner with each other, and in doing both, they end up fueling the economy. If you look at everything that's happening in the AI space, the valuations have reached such a level, the spend has reached such a level, that's before you get into the cheap energy and power thesis, that's before you get into the ability to construct large amounts of infrastructure quickly and at scale, that's before you get into the flexible regulatory ecosystems that are required to do this in the right way. You add all of that together, And it's not surprising that you have 3 countries, to a lesser extent, Kuwait, deeply involved in every major transaction that's happening in the AI space, right? And so what's interesting about it is the sovereign wealth funds, again, guided by the political leadership that run the country that are pushing an AI thesis, they signal to the market which companies are undervalued or which companies are overvalued depending on where they participate at this stage. They signal whether or not, for instance, we should be focusing on the compute or on the shell and the core by virtue of where they deploy their capital. And so in a lot of respects, the crystal ball for what's to come in terms of investing in the AI ecosystem comes from the Middle East, but in doing so, the deployment of that capital also shapes the ecosystem itself. Look, like any sort of moment of excitement, there's always a risk of a bubble. To me, what feels different about this is we have you have 5 hyperscalers in the US that have sovereign wealth funds of cash on their balance sheet. They can weather the storm. You have sovereign wealth funds in the Middle East that are deploying a substantial amount of the additional capital that's going into this, and that's before you get into Singapore and China and elsewhere. There's a lot to keep this going. And I think what's interesting about instrumental capital versus passive capital or even just kind of traditional active capital, instrumental capital has proven able to weather the turbulence of the market. And even in Saudi Arabia, to use as an example, people point a lot to projects being scaled back or delayed and so forth. That to me looks more like a recalibration than a pivot. And I go back to what I said at the beginning, this capital is patient, it's long-term, and it is heavily aligned with the domestic and international objectives.
Fantastic. Well, you mentioned the clock. We're up against the clock as well, so I'm going to leave it there. Thank you, all of you, for joining us. Remember, you can also read the essay that Jared wrote in Foreign Policy. It's actually leading the website right now, so just go to foreignpolicy.com. You'll know where to find it. And thank you to our great panelists, Deemah, Jared, Borge. Let's hear it for them, please.
Thank you, Ravi. Thank you to all your wonderful panelists for this insightful conversation. Nothing much more to add, except that we have 2 extra minutes for one final break, coffee break that we'll be taking now. But please do make sure to join us in a few minutes. And can I please ask those of you who are sitting in the front row to please leave your seats if you can as we rearrange the area. Just before we begin our final panel discussion, which will include Somalia's president, Yemen's vice president, and the United Nations Special Rapporteur, Francesca Albanese. Of course, it'll be followed by closing remarks by a very special guest this year, Her Highness Sheikh Hamza. We'll see you back here in just a few minutes.